and he will be offering expert advice in several areas, the stock market, through to property investment, and also some specialist information on investing in Phuket in Thailand. Richmond offer investment analysis, financial planning, and Graham has extensive experience in all these areas. Sought after speaker, frequent guest on CNBC, you may have seen him on TV before. And today he's going to give you his insights into the markets, and after that you can ask him questions. Obviously, if you want further follow-up on this, don't forget to check out Property Report, Southeast Asia Magazine, which I am the editor of. Enjoy the session.
Okay, welcome everyone. I don't know if anyone's heard of speed dating, but this presentation is going to be a little bit like that, because I have 60 slides to go through in 45 minutes. Because we're going to start off talking about the world, keep it simple, the stock market, then we're going to talk about South Australia, and then we're going to talk about Phuket. So don't worry if I'm flicking through it very, very quickly, because on your seats, perhaps you've got some of these forms to fill in, and if you want further information, just fill it in, and I'll send you some emails on whatever. I think also you've got something from our stand here, the Richmond stand, and anyone who's sitting here, if you attend the stand, they're offering some free holiday stuff, so anybody who's sat here and filled out, go over there, and I think you get, every day you buy, you get another day free or something. So let's get into it and be very attentive. So how do we make big profits in undervalued markets and stocks? First of all, I'm going to start off by saying, because I'm regulated by the Securities Commission in Hong Kong, that basically says, first of all, you can't read it, and number two, anything I say I can't be held responsible for. You need to go and see a qualified investor, advisor. So the first thing is, psychology is the most important factor to monitor when investing. Right now, there is a lot of negative news about the market. And the market, since it dropped in August, talking about the stock market, doesn't seem to want to go lower. Now, I guess everyone's heard of the global financial crisis by now. We follow trends in markets. We exited the market in 2007, and we stayed basically in cash until February, March, and April of 2009. If you Google Graham Bibby on YouTube, you'll see hundreds of videos from me saying, please buy, buy, buy. It was the buying opportunity of a lifetime. Then the stock market rose up until April the following year. We went 100% back in cash. Then we reinvested at the end of August 2010. I was on TV with Citibank, Deutsche Bank, and whoever saying I was nuts. There was a double dip coming. And then September was the best rise in the US stock market in 7 decades. Right now, in our balanced portfolios, we're almost 95% in cash. Singapore market, you should have been at 2.5 months ago. You've got to be, the only stocks going up are selective stocks. And I'll come on to that in a second. This is our performance. Since 2002, you put 100 grand in, even with a recent correction, you got 383,000. And the average balanced fund, if you put 100,000 in, you got 131,000. Now, how do we make the returns? It's not how you think. It's not about taking more risk. It's about taking less risk. It's about when the markets are turning negative, you've got to keep your losses small. And when the markets are turning positive, you then run the profit. Since 2002, 31% of the time, we've been in cash on different occasions. In the global financial crisis, the market went from the equivalent of 100 to 50. We lost 8%. So you get out at 92, put your money back in at 50, when it goes back to 100, you've doubled your money. It's not about how much you make when you're right, it's how little you lose when you're wrong. I do not believe in buy and hold investments. A lot of advisory firms will tell you the stock market goes up to 8 to 12% per annum. It does not. My new book's coming out next month, and I'm taking the lid off the whole stock market thing. A few people at the top, the very top, make the money, and sorry, the ants at the bottom, we're trying to figure out what's going on. And we're losing money. And we're driven by emotion, by psychology. When the market's gone down, you want to get out. Now I'm very pleased to see there's a lot of ladies in the audience. Now all you guys should give your money to the ladies. But tell you why? When there's a sale on, if it's their favourite Gucci bag or Louis Vuitton and it's 20% off, they might be in the store. But I tell you what, if it's 75% off, all you ladies will be in the store. If it's your favourite store and everything's 70% off, you'll be buying. But in the stock market, when things are on sale, people don't want to buy. At the bottom of the global financial crisis, some energy trusts were paying 20% dividend. Just over 3 years, you get your money back. Unbelievable. And this is what's happened. This is the Dow Jones. This is 1999. Here we are. 11 years, no return. But I thought stock markets went up 8 to 12% per annum. I studied cycles of hundreds of years. I studied empires, and there's a handover of an empire just happened, if no one's figured it out yet. I moved to Hong Kong in 1991 from England, right? Everyone said, oh, the world's going to move to Asia. It's not moving to Asia anymore. It's here. And the motherland, I can say that because we're in Singapore, say the same thing in Hong Kong. The motherland, China, has got the money, right? And it's not them and us anymore. The Chinese, the guys in control in China now are really smart cookies. They're not going to let Greece, Portugal, Italy fail, because if the dominoes fall, they've got big problems in China. And we'd have big problems everywhere else, but my bet would be on you would get a revolution in China. Because the disparity between haves and have-nots has got huge. But okay, if you don't really have, but you're getting more than you used to have, you're still okay, all right? And they're printing millionaires, new millionaires, like nobody's business. And we're in a global recession, okay? So how come Prada just announced 74% increase in profits? China. You don't have to make money by investing in China. You need to see where you need to go from China. This is the Nasdaq. This is not good for us because we follow trends. So the market, since the beginning of the year, has been in this range. You get buys, you get sells, you get buys, you get sells, you get buys. And then in August, the bottom fell out of the market. We went down, but right now, we got higher bottoms, this is called higher tops, and we got an uptrend. One of the books I've got coming out is how to really trade the stock market. Not how you think you trade the stock market. Full the 52-week e-classes on how to actually make the money. Now, anybody heard of this funny company called Crocs? They make the funny plastic shoe. This is how logical the stock market is. 2007, the stock price, $72. The bottom of the global financial crisis, 50 cents. In the Richmond report, which you get if you're subscribed to How to Really Trade the Stock Market, at $1, we said this is a buy, the trend has changed. Even with the recent falls, is $27 from $1. 2 years ago, $1. You put in 100,000, you got 2.7 million now. What I'm seeing here, Visa had this bottoming out formation, hitting new highs. The stock markets are hitting new lows. Visa, this is a recent trend, that's a correction that happened in 2010. This is the uptrend. MasterCard, the same thing, new highs. You've got to go and look where the China effect's going. Because even though, I don't know if you get this in Singapore, if you went to follow out the laugh, go for a holiday for a few days in Hong Kong and stand outside of Louis Vuitton, I guarantee at some stage in the day, you'll see some people coming out, bags everywhere. But you have to speak Mandarin to speak to them. And you ask them, well, as a guaylo, I ask them, you know, why are you buying all these bags? Why are you buying all this so expensive? Because we can. Well, how come you can? You buy the copy. We buy the original. That's why in China right now, if you want a Porsche Cayenne, 12 months you cannot get it. You go in with the cash, cannot get it. In Germany, two-tier economy. Mercedes, BMW, Porsche doing fantastic. Ordinary economy not doing well. You heard somebody say, I think the other day, about Australia. If you're in the mining, average salary, 150 grand for driving a truck. But the average salary in Australia is 65,000. But if you're in the mining, China. So think China. I don't know if this is a Chinese proverb, but I made it up. I think it is. I said, if you throw the stone in the pond, you don't have to invest where the stone lands. Go where the ripples are. But we all know, last 10 years, China's growth phenomenal, right? If you put 100 grand in the Shanghai stock market, you'd have 110 now. In 10 years. Less than 1%. Because the stock market doesn't work how you think it works. So sometimes you look at maybe China, we look at commodities, we might look at Australia, and I'm going to tell you something about property in a sec. Las Vegas Sands. Baby. Las Vegas Sands, and we, look, here. This stock is up 48 times in 2 years. Stuck in 100 grand, you got 4.8 million. This is an American company, right? Wrong. Wind resorts, let's go back to 2009. 20 to 147. 2 years, 7 times your money. This is a US company. Wrong. These are Chinese companies now, as far as I'm concerned. Because they're making all the money from Macau and from Sentosa. You know, Singapore was on its knees before the casinos came, right? I tell you what, I've been here 21 years, and I would never have put money, I don't know if I can say this, but I never would have put money on the government here allowing casinos. But what a smart move. That's made the Singapore economy very strong. Very sad for a few people, because the property is so expensive, right? But if you want to make money, you don't have to make money in the property that you live in. In fact, you probably don't want to invest in the property you live in. You invest your money somewhere else. Like, I'm going to tell you a story in a minute. I'm renting a property in Adelaide, right? And I'm paying $450,000 a year to live there. So I didn't invest my money in the property I live in. I didn't want to invest in it. It's got a long driveway. You can turn the car, you can park 5 cars there. It's got 5 bedrooms, it's got 3 acres, and I'm paying 2,000 Sing a month to live there. Terrible. While my investments are making me 450 grand. Anyway, we'll come on to that. Wind resorts had a little correction in August, hitting new highs. Now, what else are we looking at? This is a very hot topic, uranium, right? You see all the TV all the time about nuclear energy. I've got a whole report. If you fill in those forms and you stick on it if you want to know about uranium, nuclear energy isn't going away. The Prime Minister of Japan said if they ban nuclear energy, you're going to turn the lights out in Japan. They will not have enough power. China, in the next 2 to 3 years, will start to build 2 new nuclear energy plants per week. From next year, there's not enough uranium supply. Because what's been happening is the decommissioning of the Russian nuclear missiles, they recycle the uranium, is virtually coming to an end. Then there's a shortage of uranium. But markets don't move on logic. Look, this baby, it's gone from $4 to $1. To go back from $1 to 4 is obviously 4 times. These babies, don't invest in it now. The trend is down. But when the trend reverses, you will make maybe like this. If this is in June of last year, went from $2 to $10. Sorry, this was rare earth. In the 2005 run-up in uranium stocks, they went up 60 times in 2 years. 100 grand becomes 6 million. But the thing is, you pay for patience. The trend is your friend until it's not, and then you get out. In my opinion, is irrelevant because there's only one constant winner. It's the stock market. So you need to look at it and ask yourself, what is it telling you? And again, you want to look into that. Rare earths, right? Any of the new technology, the hybrids, solar, windmills, even the nuclear energy plants, all need rare earths. But 97% of the rare earths are controlled by China. Recently, there was a little argument over a little Japanese island. In China said, okay, Japan, if you want to argue about this, we're not letting you have any more rare earths. Japan came to the table. Well, they said to Toyota, you can have all the rare earths you want, but you come and build the Toyotas in China. Rare earths, there's not enough, right? The US military cannot exist. None of the machines work without rare earth elements, right? But this is what's been happening with rare earth. 10, so I think it's about 3 now, in 6 months. Now, look at this look. This is the element, you might think of it as metals, that make up the rare earths. They're up 2,500% in 6 months, 2,000% 6 months, 1,600%, 5,000, 8,000%. So what you've got in the ground as a company is now worth 2,000 to 8,000% more than it was before, but your stock price is going through the floor. Well, because markets are driven on emotion, human psychology and mass psychology. I guarantee all of you, if I could control your life for the next month, in everywhere you went, everybody kept telling you about how much money they were making in the stock market. By the end of the month, you will be thinking, geez, I gotta get into the stock market, man. Everybody's making a killing. That's why people want to get out, but it's down, because everything you read is doom and gloom. But everything goes down at the same time. The world is connected. I can tell you companies that are growing 30% per annum whose stock has gone down 20 to 30% in the last 3 or 4 months. They are so cheap, but you have to wait for the trend to change. This is molycorp. This is what happens to the rare earths when they take off. This one went up 8 times in 1 year. 800% 1 year. Now, I've got an offshore superannuation scheme, I don't mind telling you, and I'm just reserving it, the whole thing, for rare earth and uranium stocks. Because when those babies move and people get it, and it takes a while for it to sink in, then we're talking about 20, 30, 50 times your money. But the secret is when to pull the trigger. This was our performance in 2006. There was a blip in the market. We lost, in 3 months, even though we used stop losses, we lost 24% because the market's got to be through our stop in week the next day. It was up. We were down 22% in 4 months. But last time we were down, in the next 14 months, when the buys came through, we made 78%. If you want to play in the stock market, you've got to realise losses are the cost of doing business. But you've got to try to keep them as small as possible. I think I told you a bit about this already. This is when we started to reinvest, February, March 2009. Then we got back out here. Then we got back in again here. And then in this period here, it was the best September in 7 decades. So conclusion, stock market, decide whether the dip is a simple correction or a long-term thing. Then you've got to take advantage of whatever's going on by using stop losses. Somebody on the TV was saying to me, look, I know you've got these investments, but we think the stock market is going to go down and have another big down leg. I said, so what? Stop losses have been triggered, we'll be out. And if the stock market's going down and down and down, you know who it's good for? It's good for the guy who's not investing. Because as we know, what goes up must come down, what goes down will go up. And I started in this business too long ago, 30 odd years ago, when the UK stock market went down 86% in 18 months. Wiped off 25 years worth of profits, and then after that date never stopped going up for another 25 years. Let's look at the Great Depression. Some people say we might be heading for the Great Depression again, right? The Great Depression, the down years were 1929 to 1933. If you ignore, there was a rise of 9 months when shares went up 400%. But anyway, what I'm trying to get, 1929, 1933, 4 years, and then you had 25 years of up years. So when the trend's down, cut your loss, get out, wait. Trade with a plan, when to enter, when. How to exit. Don't limit your profits. There's this stupid saying it's never wrong to take a profit. It is. And what in August, the fund managers are the stupidest people out. They sell the good stocks and kept the dogs because they don't want to crystallize the losses. If you're in the winner, my team's Man United, by the way, and if you're winning the league, you don't suddenly start supporting Stoke. You follow the winners. And that's why the best managers get the success, because they're looking for stocks to go up 100%, 200%, 300%. You got one stock that goes up 100%, you can have 20 stocks that go down 5% and you still didn't lose any money. Because when you read my book, I'm going to frighten everybody, people call it investing. If you start off with the philosophy of gambling, you will make money in the stock market. You got my contact details, that's my disclaimer. Let's get on to something else.